Welcome to Fireside Chat. My name is Sai. If you have a job or a business that has irregular income or cash flow, budgeting could be extremely difficult, especially if you're trying to pay off your debt. So what should you do if you don't have a steady monthly income? If you've been following my channel, I talk about how my family and I use the pay yourself first budget strategy that prioritizes investment over expenses to achieve financial independence. If we had irregular income, then we would use the zero-based budget strategy to prioritize expenses over investment, unless our income to expense ratio is greater than 4:1. So what that means is if our expenses were $2,000 a month and we made $8,000 a month in take-home income, then we would use the pay yourself first budget strategy to prioritize investment. If our income was too volatile, then we would stick to the zero-based budget strategy and prioritize our expenses. First, you need to figure out what your baseline expenses are every month. These are the expenses you need to keep a roof over your head and keep the house running. So if you look at the chart here, my wife and I prioritize our essential expenses by these categories. And our number one is housing, which includes our mortgage payment, HOA, and anything else we need to pay to make sure we don't get evicted. And underneath our housing, we need utilities to keep our house running. We have electricity, gas, water, sewer, trash, internet, and maybe cable. Underneath our housing, we need groceries. When you budget with irregular income, I would only include groceries in your baseline expenses. I wouldn't include dining out because that's a discretionary expense. On the separate bubble, we have transportation. Even if you don't have a car, you still need to pay for public transportation to get from point A to point B. I would put gas, car insurance, and vehicle maintenance in this category as well. On another bubble, this is where I list our medical, dental, and life insurance payments. And there's a separate bubble for debt if you have any. This is where you will list the minimum payment for each debt. So for example, if you have a car payment for $300 a month and a student loan for $350 a month, you're going to put them in this bubble. Once you have listed all your baseline expenses, and let's say you add them up to about $3,000 a month, you also need to calculate how much you spend on discretionary spending. That means your clothes, shoes, restaurants, gym memberships, subscriptions, or video games. This category will help you decide if you need to cut down any discretionary expenses when your income becomes volatile. Let me give you a quick example. But first, if you want a free financial independence resources like Spreadsheets, you can visit us at firesidechat.com/contact. In February, you made $5,000 and that covers your baseline expenses of $3,000 and maybe another $500 in discretionary expenses. And then you're gonna put the rest into your savings or pay down your debt. However, you're projected to only make $4,000 in the month of March, then you would likely cut your discretionary expenses so that you could pay down your debt or save more money. So when a client of mine has issues with irregular income, this is what I tell him or her. I will look at the monthly income for the last 12 months from January to December and figure out the average monthly income. You might be an AC repair person who makes a lot more money during the summer months, but not so much between December and February. Once we figure out the average monthly income, I would create a completely separate savings account just to save your excess income. So if you made extra, let's say $5,000 each month in June, July, and August because you repair more ACs, then I would throw all that excess money into the high yield savings account to cover expenses in the winter months. You need to be very strategic about this, and this concept applies to both personal and business finances because you still don't want to overspend during the months when your income is high, or you could end up going into negative cash flow during the winter months. If your income to expense ratio is really tight, I would consider boosting your emergency fund from 3 months to 6 months, or maybe 3 months to 9 months, depending on your income and expenses, especially during those first few years. Once you become more comfortable with your irregular income and you have more predictable expenses, then you can budget better for the next year or so. You don't want to be stuck in this routine forever. Your goal should be increasing your income over the years so your baseline income to your baseline expense ratio increases over the years. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.